For the timing, let's turn our attention to the auto ancillary space because CEAT reported a healthy set of numbers in Q3. The margins hold on to levels around the 13%, while increased raw material costs, that's dented the gross margin a little bit. To discuss what happened in the past quarter and how are things shaping up, we're joined by Mr. Arnab Banerjee, the Managing Director and CEO at CEAT. Hi, Mr. Banerjee. Good morning and good to see you in today and wishing you, your team, all the best for 2026. Well, Q3 appears like a good one in terms of growth. And as I'm looking at your mix, replacement is a large part of your business. So could you tell us the trends that we saw in the past quarter? Are they expected to continue? And if you could help us out with what is the volume growth you're targeting for this year and the next?
Well, past quarter has been good. I think after the GST revision in the month of September, initially we saw trade downstocking, but it's all come back. And there is a good sentiment in both OEM and replacement market in the domestic area. We have seen mid-teens to high teens kind of growth in replacement. And we have had a base effect of OEM. Our last year base was a little bit lower. So good growth in OEM as well. And we'll have to wait a while, maybe a couple of quarters to see if this kind of impetus continues. Because Q3 usually is a weak quarter for us because of the onset of winter in north and east. It has broken the trend because of these changes primarily. And that's why we have brought forward our investment plans in passenger car tires as well, as you know.
Right, let's talk a little bit more on that then. You're looking to add close to 35 lakh tires per annum. And that capacity is expected to come on stream in the first half of FY28. Break it down for us. What would that be in terms of the total capacity addition? And how do you fund it? I think you've earmarked close to around 1,300 crores. So the breakup between debt as well as internal accruals?
Well, yes, the capacity, we will add about 35 lakh tires through the year. And overall capacity after this addition will be about 60,000 tires per day. So you can multiply that by 350 days to get the annual capacity. And this will service primarily all segments, replacement, OE and IB. The expansion is coming up at Chennai, which is a brownfield expansion. So we don't expect too much of uncertainty there. It will be funded by a mix of debt and equity. Our ratios, as we see going forward, will be well within our internal control limits. The debt equity currently is at 0.6. Debt EBITDA is also around 1.5, 1.6. So we don't expect to worsen those equities too much, as we have been regularly incurring capex, if you have seen over the last few years. And so it will be the capex guidance for the next few years also will be similar as a percentage of sale.
All right. Just one thing, sir. So you'll be at roughly around 2 crore capacity then. This is roughly around a 15 to 20% increase in your total capacity. That should be a fair estimate, right? 60,000
per day. Yes.
Yeah. All right.
Mr. Banerjee, good morning, sir. Prashant here. I had a slightly, top-down question, but I think it's important because, credit, and my starting point is credit growth. Credit growth was 16, 17, 18%, and it fallen as low as 8%. Now it's back at about 13, 14%, right? I mean, when you look at where this credit growth is going, autos is right up there. In terms of right, and this is instant injection of liquidity. So this is credit growth is equal to sales, pretty much, right? 1-to-1. Are you getting that sense that this could be? I don't think expectations from auto companies that we speak to is of anything great. Maybe better, etc. But is it possible as credit growth picks up and continues to move higher, driven by all these policy measures, this turns out to be a pretty we see a meaningful upside surprise in terms of auto volumes. Is there any sense in your interactions with OEMs?
Yes, I think, there was a structural change in the four-wheeler auto sales where we see the emergence of SUV, when the first-time buyers going straight to the SUV, leading to value growth. But the volume growth was muted in terms of number of cars. Post the GST, that thing has changed, because the small car volumes have come back. So That means larger number of tires, of course, but we'll have to wait and see whether the structural change towards consumer preference of higher vehicles, bigger vehicles, the SUVs is going to come back. But the overall numbers are definitely going to increase. How much, we will have to see for the next 2 quarters. Two-wheelers and farm are going to see a secular growth because we have seen the growth momentum coming back more from the smaller towns. So we believe that these are still, two-wheeler is an underpenetrated category still, and there is scope for growth in terms of number of vehicles there. And because of the credit growth, which you mentioned, we have seen a bounce back in the commercial vehicle segment as well, which is truck and bus. And this was kind of not growing in the first half, nor was passenger in terms of numbers. So these growths have come back to, yes, it has been bullish, but we'll have to see a couple of more quarters to see how much sustains.
Mr. Banerjee, time for just one question. So let me squeeze in 2 quick ones. One, what percentage of your overall revenues or volumes go to the US? I know it's small, but can you give us a number? And on the back of the punitive tariffs, what has been the volume in Q3? And what is the outlook on margins for Q4, given the way rubber prices have panned out and the currency depreciation?
So I'll answer the US question first. Less than 3% of our turnover goes to US. And as I had been maintaining in the past, for us, it's important to get a toehold in terms of creating the distribution and logistics infrastructure in US. So we had been absorbing the tariff impact to a certain extent and passing on by certain extent. That strategy continues over Q3 and also Q4. We have not seen any drop in sales turnover, therefore, to the US, though it remains small, and impact on bottom line is muted. We see this as a very big growth market, so we stay invested in US. So that's the US part. No impact on bottom line, but we are setting it up for growth in future. Overall margins, if you see, standalone margins have inched up from 13.7 to 14.1% in this quarter because of higher turnover and growth. We expect the raw material situation to be flattish in Q4, maybe slight inflation of max up to 1%. So mostly flattish, maybe slight inflation. That is a kind of situation. By end of February, we will see an uptick in volumes, the seasonal volumes, which kicks in for the period of March to June, the summer volumes. So we expect the overall margin for the company to move in similar zone.
All right, very quickly, sir. Your net debt is around 2,930 crores. Does this number stabilize around this mark? Because you've got a capex as well that's lined up. And would it be fair, going by your commentary and the capex that you're adding, that you will be looking at growing at least at mid-teens for the next couple of years?
Value growth this year, I can say, will be close to that, because first 3 quarters, as per published results, you can see we have grown by mid-teens. So we want to continue that trend for this year. Next year, it's too difficult to predict, 2 years at once, but we are laying the foundation, as US is one of the growth measures. We are laying the foundation for domestic growth in terms of OE approvals, as well as replacement channel expansion, especially in the premium side, which is the SUV side. So we are planning for at least double-digit growth going forward.
Mr. Banerjee, we'll leave it there. Thank you very much for joining us. Good speaking with you. And thank you for being here.